I have never once sat down at the end of a month and tallied my spending against a category-by-category budget, not once in my adult life. This surprises people. They expect a man who has preached frugality, discipline, and long-term thinking for 7 decades to be the sort of person who tracks every dollar against a spreadsheet. The personal finance industry would certainly have you believe that budgeting is the cornerstone of financial virtue. It isn't. And after 60, the conventional budgeting model doesn't just fail to help you. It actively misdirects your attention away from the financial decisions that actually determine whether your retirement succeeds or collapses. I'm Charlie Munger, and I want to give you a framework that is simultaneously more rigorous and more liberating than any monthly budget you have ever attempted. Not because discipline doesn't matter, it matters enormously, but because after 60, you are optimizing for an entirely different problem than the one a traditional budget is designed to solve. And using the wrong tool for the job, no matter how diligently you apply it, produces the wrong result. Part 1. Why budgeting works before 60 and fails after. Let me explain precisely why I am not opposed to budgeting in principle, only to its misapplication in retirement. During your working years, the primary financial challenge is accumulation. Your income is largely fixed. Your savings rate, the percentage of income you direct toward the future rather than immediate consumption, is the single most powerful lever you control. A budget is a tool for maximizing that savings rate. It helps you identify where spending is occurring, find the friction, and redirect money toward compounding assets. That is a legitimate and valuable function. During accumulation, budgeting done well can meaningfully improve your financial trajectory. But retirement changes the fundamental problem completely. You are no longer trying to maximize what you save from a monthly paycheck. You are trying to ensure that a finite pool of capital, your accumulated savings, sustains your standard of living across an uncertain time horizon of 20 to 30 years. Against the constant erosion of inflation, against unpredictable healthcare costs, and against sequence of returns risk in your investment portfolio. A traditional monthly budget, tracking groceries, utilities, dining, entertainment, addresses none of these risks. It is managing the surface of your financial life while the structural foundations either hold or crumble beneath you, largely unexamined. I have a principle I return to constantly. Always work on the big things first. In retirement, the big things are not your cable bill and your dining out frequency. The big things are your withdrawal rate, your portfolio structure, your tax sequencing, your healthcare cost exposure, and your longevity assumptions. These are the variables that determine whether your retirement succeeds. A traditional budget ignores all of them. Part 2. The real risks that budget thinking misses. Let me show you what I mean concretely. Here are the 4 variables that will actually determine the outcome of your retirement, none of which appear in a monthly budget. Your sustainable withdrawal rate. The percentage of your portfolio you withdraw each year is the single most consequential number in your retirement. Research has consistently suggested that a withdrawal rate of approximately 4% or less from a diversified portfolio has a high historical probability of sustaining a 30-year retirement. Above that, particularly combined with the poor sequence of returns in early retirement, the mathematics become considerably less forgiving. The retiree who is carefully tracking their restaurant spending on a monthly budget but has never calculated their actual withdrawal rate and whether it is sustainable against their portfolio size, inflation assumptions, and expected longevity has their attention precisely backwards. They are measuring the irrelevant and ignoring the critical. Your tax withdrawal sequencing, the order in which you draw from different account types, taxable brokerage accounts, traditional IRAs and 401ks, and Roth accounts, has enormous tax consequences over a multi-decade retirement. A well-sequenced withdrawal strategy can legally reduce your lifetime tax burden by tens of thousands, or in larger portfolios, hundreds of thousands of dollars. This optimization is invisible to a traditional budget. You cannot find it by tracking monthly expenses. You can only find it by studying the structure of your accounts and the tax code that governs them, or by working with a fee-only advisor who understands both. Your healthcare cost exposure. Healthcare costs in retirement are not a line item in a monthly budget. They are a catastrophic risk event that requires structural preparation, a serious illness, a long-term care need, a significant surgical episode. These can generate costs that no amount of grocery tracking or entertainment trimming will address. The average retired couple in America faces healthcare costs well into the hundreds of thousands of dollars over the course of retirement, beyond what Medicare covers. This is not a monthly budget problem. It is a portfolio sizing problem, a long-term care insurance problem, and a health savings account utilization problem. The retiree who has a monthly budget but no healthcare cost contingency plan has optimized for the wrong variable entirely. Your longevity assumption. Most people unconsciously plan for an average life expectancy. This is a planning error of the first order. If you plan to age 82 and live to 94, you have not made a budget error. You have made a structural error, one that no amount of monthly expense discipline would have prevented. The correct approach is to plan for a long life, 90, 95, or beyond, and structure your portfolio, withdrawal rate, and Social Security timing accordingly. Longevity is the risk that makes all other retirement risks worse. It deserves to be the organizing assumption of your plan, not an afterthought. Part 3. What to do. Instead, the Munger framework. Here is what I recommend in place of a traditional monthly budget after 60. Not because it is easier, it requires genuine intellectual engagement, but because it addresses the actual problems. Build an annual spending plan, not a monthly budget. Retirement spending is not linear. It does not occur in neat monthly increments. Property taxes arrive semi-annually. Car repairs arrive unexpectedly. Travel spending clusters in certain seasons. Medical expenses are lumpy and unpredictable. A monthly budget creates false precision around a fundamentally irregular expenditure pattern. Instead, calculate your total annual spending across all categories, including the irregular ones, and compare it to your total annual sustainable withdrawal. That single comparison tells you more about the health of your retirement plan than 12 months of category-by-category monthly tracking. Identify and eliminate your structural leaks. There is a category of spending I call structural leaks, recurring costs that were established years ago that you barely notice and that persist not because they provide ongoing value, but because you have never stopped to re-examine them. Subscription services. Insurance policies that have not been reviewed in a decade. A financial advisor charging an AUM fee on a portfolio that could be self-managed with a simple index fund allocation. These structural leaks, compounded over a 25-year retirement, cost far more than any dining out reduction a monthly budget would identify. Audit every recurring payment in your financial life once a year. Eliminate what no longer serves you. This annual audit produces more financial benefit than 12 months of monthly budget. Enforcement. Optimize the 3 decisions that actually matter. In retirement, 3 decisions dwarf all others in their financial impact. When you claim Social Security, how you sequence your portfolio withdrawals across account types, and whether you carry appropriate long-term care coverage. Delaying Social Security from age 62 to age 70 increases your monthly benefit by approximately 77%. For a couple where one spouse has a strong earnings record, the optimal Social Security strategy, factoring in longevity, spousal benefits, and tax implications, can be worth $100,000 or more in lifetime income. No monthly budget produces that outcome. One well-informed decision does. This is what I mean by working on the big things first. The small decisions, the coffee, the dining, the subscriptions, are not irrelevant, but they are not where the retirement is won or lost. It is won or lost in the 3 or 4 structural decisions that most retirees make once, without full information, and then live with for decades. I want to be clear about what I am not saying. I am not telling you to spend without consciousness. I am not suggesting that discipline is irrelevant after 60. Financial discipline remains essential, but discipline, properly applied in retirement, looks like maintaining a sustainable withdrawal rate through market downturns, like resisting the pressure to make impulsive portfolio changes when financial media manufactures urgency, like systematically reviewing and eliminating structural costs that no longer serve you. It does not look like agonizing over whether you spent $340 or $290 on groceries in October. The personal finance industry has, in my view, successfully persuaded millions of people that financial virtue is expressed through micro-level spending control. It is a comfortable belief because it gives people something to do. Categories to track, numbers to hit, a feeling of productive engagement with their money, but it is largely a displacement activity. It substitutes the appearance of financial management for the substance of it. After 60, you do not have time for displacement activities. You have, at most, a handful of years in which your financial decisions are still fully reversible, in which the structural choices about withdrawal strategy, tax sequencing, Social Security timing, and healthcare preparation can still be optimized. After that window closes, you live with what you built. Build it right. Work on the big things. Let the small things follow. A man who gets the big decisions right can afford to be sloppy about the small ones. A man who gets the big decisions wrong cannot save himself by being careful about the small ones. This is true in business. It is true in life. And it is especially true in retirement.